Scott, excited is probably not the right word, but looking forward to having a conversation with you just as a brief market update with all the action over the last week or two. Wanted to spend a little bit of time talking about where things have been, where we are, and where we feel like things are going to go. So, um, why don't we start with just the volatility of the last couple of days, if not weeks. Talk to me a little bit about kind of what your thoughts are on where we've been.
Yeah, I think what's happened over the past couple of weeks is some investors, probably more like speculators though, or hedge funds even, are trying to reset expectations for stocks based on what is the new tariff. I don't want to call it policy because I'm not sure that it's actually policy, but tariff expectations. And because I don't think anybody is an active investor who's alive who can speak to the last time that tariffs have been increased like this, at least not from a US standpoint. So because no one has any real experience with it, we're having to, again, I'm going to use the word reset because I think that's what it is, reset and try to recalibrate what stocks and bonds look like going into a new trade regime. Anytime you invest in stocks, there's some, conjecture about the future. You have to, you're buying today based on what you expect earnings growth to be, or whatever your metric is for buying stocks, and from that you can extrapolate a future price. When things are fairly steady, the standard deviation, we'll call it, of outcomes for that stock is relatively low. Of course, the stocks could have blowout quarters or terrible quarters or whatever. But for the most part, the standard deviation of expectations isn't very high. That leads to higher valuations because there's less perceived risk. When you have something like what we've got now, which unprecedented is not the right word, but certainly unfamiliar to investors, now the expectation gap has widened tremendously. The variability between what could be a good outcome and what could be a bad outcome. And because of that, P ratios come down. There's less, I'll use the word certainty. There's never certainty, but I think there's some expected or perceived certainty in future stock prices. So because of that, PE ratios have come down, which is exactly what you've seen so far. I don't know if earnings expectations have actually come down for stocks. It's been pretty minimal. Now, it wouldn't surprise me if we saw more of that going forward. But really, all this is just price reaction to new tariff goals.
Yeah, and important to note, the economy and the stock market are not the same thing, right?
Right.
The
Yeah.
economy is, or the stock market is a component of the economy, but I would argue the economy itself hasn't had a chance to digest any of these adjustments, at least not yet. But the market, and you may know who said it, or I may get the quote off a little bit, but in the market in the short run, someone said, market in the short run is a voting machine. Over the long run, it's a scale. And you've definitely seen a fair amount of turbulence in the short run. But again, I don't think the economy's had an opportunity to even digest any of this yet.
I would bet that it has not. Again, this is just a reset of expectations. Most economic data, frankly, has been pretty strong year to date, pretty to very strong, if we're being honest. It's weird because sentiment's been terrible, and it has been since early in the year. But for the most part, the hard data is good. Now, there's some mixed data in there also, but if I were leaning which side things went to, it would be towards a healthy economy, and that's been our expectation. Now, what do tariffs do to this? What happens when you throw friction into what has been relatively frictionless? And by that I mean trade. I think anytime there's friction, that implies a cost of some sort, and Where is that cost going to come from? Who's going to pay it? Where will it come out of? And I mean, that stands to have economic implications as we move on. But yes, I'm not even sure the first of these tariffs has gone into effect yet. I'm not even sure the policy has been set. Or, I mean, it's been set, but it hasn't been enacted. So it can't possibly have gone through. So what is happening now again is just people changing expectations. This is not a reality of something that has currently affected our economy. Now, could it in the future? I mean, I would say the likelihood is yes, but for now, so far nothing has impacted it yet. This is just people readjusting portfolios based on, I mean, honestly, guesswork about what will happen in the future.
Well, and important to note that when we say impact, I think the natural, particularly given the national news media and the kind of the tenor of that, when we say impact, I think there's the propensity to think impact equals negative, but in reality, one of the reasons that we invest is because the impact of changes can also be positive. And so, to your point earlier, that range of expectations may be bigger, but it also, I think, is just reflective of the fact that there remains opportunity. Speaking of that, you manage a lot of our client portfolios with discretion. You have the ability to make some adjustments, and you did some of that at the beginning of last week, prior to Liberation, or as I now refer to it, Obliteration Day. And so, what did you do? Why did you do it? What are the adjustments that you made, kind of from a macro level?
Stocks had pulled back a little bit in the first quarter, and so when we did the rebalance, um, we did not re-up those positions to where they would have been ordinarily. So if a stock portfolio had fallen from say 60% stocks to 55% stocks, we just left it at 55% stocks. We did not move it back up. So in other words, we did not trim our bonds and move to stocks, which we ordinarily would do. We don't usually we last week or early April is not usually when we do rebalances. It's usually in May. But we had had some, I don't know, trepidation, I guess, going into not just the tariffs, but just generally speaking, there was some technicals. I'm a big chartist. I like to look at what the prices are telling me in the stock market, not what you mentioned the media. So I'll throw them back under the bus. I'm not so much concerned about what the people on TV tell me I ought to be worried about. What I'm worried about is what are stock prices and bond prices actually doing and saying. And they were suggesting weakness. Now, they weren't suggesting we'd have a 15% pullback over a matter of 3 or 4 days. But so for those reasons, we went ahead early, did our rebalance, got a little bit less aggressive across the portfolios. Um, Across really all the asset classes, our stocks got more conservative, our bond positions got more conservative, and our alternatives positions got more conservative. So far, that's worked out really well. And I would like to point out too, bonds this year are working exactly the way they ought to be working. So anybody that has any portion of their portfolio in bonds, that portion, I with very few exceptions, is going to be higher this year. Most bonds have done very, very well. So unlike 2022, which was just miserable because bonds did not diversify, bonds also had a terrible year. This year, bonds are having a very good year. So I think for most people, aside, when you look and see that the S&P is down, whatever it is, down from the peak, that's scary. I don't like it either. But you have to keep in mind that for most people that own a allocated portfolio, there are things that are going higher in there. Many of the top holdings, when I'm talking to clients and they're saying, "Well, walk me through the portfolio," I don't know, 3 of their top 5 holdings are up year to date, because they're in bonds. So again, and that's going to depend portfolio to portfolio. Some people are more aggressive, some people are more conservative, but for the most part, asset allocation and diversification are actually working, and we're grateful of that.
Well, and I think I think it was Buffett that said, "I'd rather lose opportunity than money." that has always been, or maybe not always, but for a long time at least, our philosophy on managing money for clients is that we tend to be a little more conservative, and that has again it has slowed relative performance prior to now, but these are the times that these types of portfolios are built for. I think is again, rather lose opportunity than money. We want to be conservative, particularly in times where there's weakness. And one of the things, Scott, that we've talked about before is the Mag 7, right?
Mhm.
The even the S&P 500 at one point, roughly a third of it was made up of seven companies, and the other 493 companies made up, two-thirds of it. Those companies have done particularly poorly, I think, over the last week or so.
The Mag 7 stocks, yeah,
Yeah.
year to date. You're right. So there's been a little, I don't know what I'd call it, catching up. Maybe it's more of a catching down by those Mag 7 stocks, the big technology stocks have pulled back considerably more than the average stock. And that's kind of a rebound from last year, where last year those stocks did so well. And even in 2023, I think a lot of people felt left out of the big rally in 2024 because it was so concentrated in just 5 to 10 stocks. Um, this year, again, that's how things usually work, right? There's a reversion to the mean, and that's for sure what has happened so far this year. That we've seen the big stocks catch down to most of the other stocks. And that, I think the point you're making is for a lot of our clients, they didn't own seven stocks. We didn't have a third of their portfolio in seven stocks. Almost every review that I've done over the past year shows that we have been underweight technology to the S&P 500. Now, last year, was that sort of painful to watch those tech stocks go up by so much and be left behind? Yeah. But did it work out, over, say, a 12-month period of time? Absolutely, it did. Because we haven't been as exposed to a lot of the recent drawdown. So yes, that has definitely happened over the past couple of weeks. There has been a rebalance of performance.
Yeah. I saw that in both directions, and I think that I think it was Buffett that said in the short run, the market is a voting machine, and in the long run, it's a scale. And that uncertainty has certainly driven the short run. But ultimately, I think that particularly as we're talking about the U.S. companies, we're talking about the greatest companies in the country, if not in the world. Long term, I think the scale will work out just fine. Doesn't always make it particularly comfortable in the short run. What do you think? So going forward, what are your thoughts? Obviously, not making major changes as a result of the last couple of days market action, but just give me some thoughts on kind of forward looking.
Yeah, well, to your point about not making major changes now, the major changes had to have already been made, really, and often those are made when we initially meet with clients and we determine what asset allocation is best for them. So, they might disclose to us that they're risk averse or they're very, or they want risk or whatever it may be. And so we'll marry that together along with our outlook for stocks and bonds and try to come up with the right portfolio. And the resulting portfolio is something that's got some sort of insurance in it. So, and because if we didn't care about downside, we would just own stocks, right? Because stocks tend to outperform bonds. Historically, they have outperformed bonds by very large margins, depending on which bonds you're in. So what we do by putting bonds in the portfolio, again, it's insurance. Bonds, they tend to earn income, which can reduce portfolio volatility. They tend not to be as volatile to reduce portfolio volatility. So those decisions have largely made before events like this happen. the software that we use to help people in their allocation guidance, it takes thousands of different past events, however many, it goes back 50 years or so or whatever, and juxtaposes the years in different orders so that we can come up with different scenarios. Like, so how will things look? And so we try to build those portfolios based around the thousand different things that are most likely to happen to a portfolio. It takes into account stuff like this because even though maybe the tariffs aren't the same, stuff like this has happened before. 2020 happened before. The great financial crisis happened before. The dot-com bubble burst happened before. 1987 happened before. So these things can be modeled at least. So as far as the portfolio changes, I think if someone were bringing money in right now, we'd be pretty conservative about putting it to work. Now, I will say I would put some of it to work right away just because it looks, the market looks very technically oversold to me. And even if I look fundamentally and I adjust down earnings expectations, GDP expectations, man, it's hard for me to adjust them down long enough to make current stock prices look too high. In other words, even when I adjust them downwards, stock prices still look low. So I do think that technically and fundamentally, we're probably a little bit undervalued. Now, what I can't take into account for is public sentiment. And if short sellers are selling stock or whatever, I can't do anything about that. So could they take the market down more? Sure. But I think that if we're just objectively looking at where prices are right now, the market has been oversold. It more likely than not bounces back to some degree. So I would make sure to have some money at work right now. But I'm like everybody else. I mean, I don't know what tariffs are going to do to the market or the economy. We're going to have to just see as we go along. So I think that does mean, we want to have, be a little more cautious than maybe we ordinarily might be, just because, as we discussed, that spread between possible outcomes has widened.
Well, and anytime you go through a major change, right? This has felt major to investors, I think, or at least to some. Um, Psychologists would tell you not to make big decisions based on during times of turbulence, whether that's a death, divorce, again, I would say market correction of a particularly volatile. You don't make long-term decisions based on short-term circumstances, and so I think, to your point, I don't think that the long-term trajectory of I don't think that this policy is going to be the way that it was rolled out last Tuesday for an extremely long period of time. In terms of the particulars, that all the exact rates that were rolled out, again, I think the administration has suggested that they intend to negotiate from there. One would expect that things, again, depends on what side of things I guess you're looking at, would ease in terms of what those rates were. I wouldn't expect that they were pretty tough to begin with. I don't expect them to necessarily get tougher. I think if some of the other countries come to the table, that will improve, which would, again, I think we probably have priced in some pretty bad expectations that likely aren't going to be the full truth when it's all said and done. I also think that the policy changed in a really quick fashion. And again, the easing of, as part of negotiations and things like that, can happen equally quickly. This is not necessarily a 30-year policy change. It is what I believe, at least, it may be philosophically longer, but I don't think that the rules of the road are going to be exactly what they were,
Yeah.
last week.
Yeah. We're one tweet away from all this being undone.
So,
And that's the other
again,
danger.
good.
So for people who did react emotionally to this, and I get it. It's hard not to be emotional about it, but that's the flip side of this is that no kidding, we are one tweet or X or whatever it is away from the market recovering all of this. So do you want to lock in a loss? I mean, I would think not, unless you've got extraordinary circumstances. Then I wouldn't be looking to lock in a loss. So yeah, it can be undone just as easily as it has been done. And historically, most of the market's best days have occurred within, I think it's something like 15 days of the market's worst days. So, I mean, the odds favor a bounce back of some sort in stock prices. You've mentioned a couple of quotes, and I will bring one up too, and I hope I don't get this too terribly wrong. And I believe it was Jack Bogle who founded Vanguard Funds, and smart guy. Obviously knew what he was doing with regard to investments and investors. The quote was something to the extent that the purpose of the stock market is to distract people from the business of investing.
Hmm.
And I believe that what he meant was that by looking at the S&P's up this or down this or whatever, it's taking away from what that person's goals for their investments are. The S&P does not care about your goals for your life or your investments or anything. It just doesn't. It shouldn't. That's not its job. You make a plan to set up for all those things, and you can't let excuse me, you can't let whatever 4% move in a day in the stock market, while very wild and volatile, undo what you can't let it have too much of an impact on what your goals are. Because again, the market didn't go up last year based on your goals, and it's not going down right now based on your goals. And I believe that that's what Mr. Vogel was trying to say is that you're getting distracted by the wrong things.
For
Pay
sure.
attention to why you're investing, and the rest of it will take care of itself.
Well, and I think it was Vanguard in their Advisor Alpha study showed that the value of working with a financial advisor, two-thirds of the value came in part from uh,
Right.
behavioral consulting and making sure that we stay the course and continue to do the next right thing. So, Scott, one of the things you and I talked about some this morning was some things that people can do now to make smart next decisions today. So what are let's touch on as we kind of begin the process of wrapping up. Let's touch on uh, some things that people can be doing if they continue to be long-term investors. They have a plan. Uh, we don't want to make major changes, but it could be an opportune time to do a handful of things. Are there things that people should consider doing now?
Well, one of the things that we'll be doing actively in portfolios is tax loss harvesting. Um, I don't buy stocks for people with the hopes that they're going to go down so that we can pivot losses on them. I'd rather, have lots of gains every year, but that's not how the stock market works. So we'll, make some lemonade out of lemons, I guess, and say that, if we bought some stocks and they're down and we can sell them, realize that loss, switch that stock into something similar, because I still want to participate, right? Again, I don't want to lock in a permanent loss.
No, but you
But
could switch from Coke to Pepsi.
correct, yes, as an example, and still be involved in the same sort of thing. Take in the loss. Maybe I don't need the loss next year, but you're allowed to carry them over. Talk to your tax consultant about all that. But you can do that not in IRAs, but outside of IRAs. If you're inside an IRA, consider a Roth conversion. The value these stocks is probably down. If it recovers, and you can do that in a tax-free manner inside of a Roth IRA, as great as an IRA is because it's tax deferred and we don't have to worry about the tax implications of day-to-day events. A Roth's even better because it's tax-free as long as you follow the rules. So you could I think both of those are strategies definitely worth considering right now, again, to make lemonade out of lemons.
Sure. And if you're somebody um, who hasn't made their IRA contribution for this year, good time to be able to do that, whether traditional or Roth, right? I mean,
Right. Yeah.
you essentially would be buying into whatever today at a discount from where it was, a week ago. And again, these are if I guess my thing is, Scott, we don't necessarily want to deviate from the plans. That's the whole point of having a plan, is that then you steadily implement and execute on it. However, we certainly can utilize timing and opportunities in our favor based on how we execute the plan. Uh, the rebalancing of portfolios a little early, taking this as an opportunity to do Roth conversions or to make IRA contributions. These aren't things that are outside the plan. It's just that if you were going to do them at the end of the year and you think that the market will recover, maybe do it now. So I mean, again, not major shifts, but it's little hinges swing big doors. And
Mm.
a big part of what we want to do is do the next right thing. So, Scott, any kind of closing advice for people?
Yeah, I'd like to recount something that I wrote up in my most recent market newsletter update. So this comes from the Morgan Housel podcast, and I would recommend that to a lot of our viewers, listeners, clients. He just got good common sense um, uh, ideas about not only investing but personal finance. He's a bright guy and is able to articulate his thoughts, I think, better than most can. But he, in a recent podcast, talked about an experiment that B.F. Skinner had done on pigeons back ballpark 100 years ago. And it was how, at first, the pigeons learned to feed themselves because they could push a button in their cage and a pellet of food would come out. But after a while, Skinner changed the experiment to where the pigeon would push the button and nothing would come out. So the pigeon would push the button again and nothing would come out. And the pigeon doesn't know what's going on. So it keeps pushing the button until the pellet comes out. And so Skinner, the point is he changed it from being a constant reward to an intermittent variable reward. And what he found was it's became addictive behavior to the pigeons. All of a sudden, they're pushing on this thing constantly. Um, and I think a parallel can be made between gamblers for sure, but also with people who like to trade the stock market, that like it becomes addictive. Like you don't know when your next reward is going to be. So you keep hitting a button until you get the reward. And that's not really how stock investing works. You have to be able to be in it for a long period of time and not keep hitting the button. And the particular example you used was the Japanese stock market, which between 1990 and 2015 returned approximately 0% per year. I mean, now it had ups and downs, certainly, but zero. Now, if you went back over a longer period of time, since the end of World War II, it averaged about 7% a year. The trick is you don't know when your returns are coming as a stock investor. That's why you tend to get compensated more for being a stock investor than a bond investor or a CD saver or something like that, because the rewards are so variable and intermittent. And you just have to know that. You like to talk about the emotional roller coaster. It's the same sort of thing. You have to know when you're in, that this is the way that it works. The more times you hit that button, you're just making yourself crazy. You're
Sure,
not
sure.
you're not adding value to your portfolio, to your plan. And again, the stock market doesn't care whether you're trading it or not.
No. Well, and again, I highlight when the national media, I want to be clear, being as my wife is in the local media business and they're amazing, honey, if you see this. Um, but the national media, their product is our attention. Social media, their product is our attention. They sell our attention. And thus, the dopamine hit of that intermediate or intermittent reward sensor, they're built for that. It's their business model. And so I think that's the, again, kind of my thing, Scott, is there's an old saying that I heard one time that says, I needed to go to a meeting for an hour. I was only going to get 6 minutes out of it, of value out of it, but I didn't know which 6 minutes they were. So I had to stay for the whole hour. And in reality, I think to some extent, to your point, that's what I heard when you were talking about the market earlier, is
Right.
we don't know which 6 minutes of this hour are going to be valuable, so we have to stay for the whole thing. And so, I would just point out, if you have a signature life plan, this has been accounted for as part of the modeling that we do for that. Doesn't make it any more pleasant, but it's not. Interestingly enough, Scott, if we talk about black swan events, right? And there's a 1% chance that this could ever happen. The fact of the matter is, math says if there are 100 things that could be black swan events, if there are 100 things with a 1% chance of them happening, the reality is one of them could happen every year. And it doesn't change the fact that they're unusual. What it does, that's just math. And so to some extent, important to, they're all always, this has never happened before.
Mhm.
That's true.
Mhm.
However, there are lots of things that have happened over the course of our average 30-year career. There are lots of wild and crazy things that have happened before. And at least to this point, the process works. And so I think that's kind of do the next right thing. Make good decisions as part of your plan. And if you don't have a plan, this would be a time to get it. I will say, if you came to me now, Scott, and somebody wanted to do a plan right now, what I would highly recommend is that we give it a little bit of time and breathing room. We talk about how we feel. We begin the process of creating a draft plan like we normally do, but that we slowly work on the implementation of that, because quite frankly, your feelings might be different a week from now. They're definitely different today than they were a week ago, because we're recording this on a Monday before Liberation Day. Was the market was up, as I recall, on the day before or the day of the ultimately the tariff announcements. You can feel dramatic, as we have proven. You can feel dramatically different in a week. So if you don't have a plan, you should, and we're happy to be here. And I would just say, Scott, that I want to remind people, if there's anything that we can do to reassure them or to encourage them, if they have cash on the sidelines and want to find a place to add to their portfolio, that we're here to help. Our whole team is here, all hands on deck, here to help friends, family members, colleagues, coworkers. If we can be a resource, that's what we're here to do.
Absolutely. The other thing you can do, and it just popped in my head, you can refinance your mortgage right now too, if you need to. If you had a high one, if you locked in a high one a year or so ago, my guess is it's % less today than it was back then, if not more. So
Absolutely.
there's another thing you can do. Rates are much lower, so
There you
take
go.
advantage.
Again, every situation does create opportunity. Money is going somewhere. It goes from one thing to another. The most important thing is, again, to do the next right thing for you. Scott, appreciate your time.
Yeah,
Of course,
thank
you'll
you.
be on the other end of things if folks need us.
Right.
Again, if you're out there, if you don't have a plan, let's begin the process. Let our team put one together for you. If you do, and you want to be reassured that your confidence number remains roughly the same despite the last week, again, it's built in there. So if there's anything we can do, we're here to help. And otherwise, we will see you soon.
Sounds good. Thank you.